Roundtable is on, which is sponsored by the Sloan Foundation and Columbia's Center on Global Energy Policy's Women in Energy program, is focused today on forecasting. And we have three great presenters, Helen Curry, who is the chief economist at ConocoPhillips, Jill Scotcher, who is an economist in corporate planning at Chevron, and Catherine Miller, who is president of BTU Analytics and a master shale forecaster. So our format is going to be that our presenters will make a short presentation. Helen's going to talk about forecasting process, and then Jill's going to give sort of an overview of some forecasting from Chevron, and then Catherine's going to do a deep dive in working with the data in the shale industry, and then we'll open it up for discussion and questions. So Helen, take it away.
Thank you. So in the interest of this being following lunch, and some people, maybe your tummies are full from the dessert, we're going to keep this very, very high level. I thought it would be best to really focus on kind of what's the process we go through at ConocoPhillips, and the slides I have will delve into a few issues at a high level, but we won't go very deep in any one thing in particular. Our lawyers tell you that. So in terms of scenario planning, I should say first that in corporate planning at ConocoPhillips, we actually are mandated with looking at both short-term markets, near-term markets, and much longer term into the future. And the slides I have here are a little bit on the long-term scenarios, but I'll say a few minutes first on the near term. When we put together our 3 to 6 month outlook or 12-month outlook for our management team, excuse me, that is very much a fundamental supply and demand exercise of the classic counting of barrels, of inventories, counting what's moving on the water, looking at demand as most recently reported for the last quarter by a half dozen different consultants and government agencies. We put together a number of things in that fashion to formulate a point of view on where the market is likely to be moving in the next 3 to 6 months, as I said. Once you start to go beyond a few months or a year or two even, you really do get into a point where there's so many different factors that are going to be shaping your either supply or demand that we have found scenarios present us with a useful way to think about the future. Now, that doesn't mean you throw out all equations by any means, but it's more a matter of building those equations, building those supply and demand relationships from more of a high-level kind of standpoint. So to address this slide, the things we tend to do with scenarios at Conoco is to look at what is some of that wide range of forces that can shape the future of energy. And by the way, I do mean energy, so it's not strictly looking at oil and natural gas. Those are the two that we are most focused on because that is the line of business we are in as a global E&P company. But we do an overall energy mix that is inclusive of coal and renewables and biomass and everything that constitutes the global energy mix. What do these scenarios do for us? They challenge our thinking. We said here sharpen our thinking on how to position the company for alternative outcomes. And that really is one of the functions that you want to that you deal with and that you do in corporate planning is your job is to help guide your management in a direction that does best position your organization to weather any number of future states of the world. So more specifically, once we develop scenarios, so that means ultimately we're generating a supply outlook, a demand outlook, and a set of prices. That then literally lets our company test business strategies against those different environments. So that just translates into we have a multitude of price decks, and the company is able to test how does our portfolio, how do our earnings perform under those different price decks. What goes along with that then is in better understanding the risks that your company is facing. What might happen? What does that do to your financials? And therefore, how might you respond? And by doing this, you can think through these things ahead of time rather than waiting for something to happen. Maybe it's a market downturn. It could be a market upturn. Both of those are cases that then present management with a lot of choices. Some of them painful, some of them more happy around how are you going to manage the company. One thing we're trying to do with scenarios is just to sufficiently make sure that our strategies are formulated and tested for resilience of the company. And then our process recognizes the world is not going to be static. We have multiple scenarios, as I've mentioned. This is just a real simple graphic. I know there are a lot of academics here at the conference, so I intentionally put no equations in this. It's just a cartoon. So it lets you just appreciate, those in the room here can appreciate that anything we do as economists does involve supply and demand when we're talking about energy. There's a lot of different aspects of that, whether it be technology, consumer taste, government regulations. You can't read all those little bubbles there. Government appears on both sides because government policies affect both supply and demand. But ultimately, it's a matter of bringing all these factors together, trying to think about them in an organized fashion, creating different scenarios that effectively represent very different states of the world, and then seeing how does your company perform in that state of the world. I included this slide because one of the topics we will touch on at some point in this session is the conversation around peak oil demand. You can think of this as a carryover perhaps from some of this morning's sessions wherein we've talked a lot about carbon reduction, energy transition. The term energy transition and to me is now part and parcel of our general language. So what I'm showing you here is just a variety of outlooks for both global oil demand as well as global natural gas demand. And all I want you to observe from oil demand is that there are a number of those trajectories that through year 2050 do have oil rising, but there are more of those trajectories that have oil either plateauing or even turning down, oil demand even turning down by the year 2050. It just so happens to be that the lowest case here ends up for oil demand ends up with the world just under 60 million barrels a day of demand in 2050. I believe this morning it was Amy Jaffe here that made the remark that even in a 2-degree world, which that lowest line would be, you still have a world, the world will still need oil and natural gas. It is not, I would argue there are no credible scenarios out there wherein you can completely take oil and natural gas out of the global mix for demand by the year 2050. The technology is not there. Furthermore, the world will go from about 7.5 billion people to for almost 10. A lot of those people are going to want electricity and a modern lifestyle as we enjoy in the United States and many developed countries, and that means energy. That tends to mean oil at some point because it's a very cost-effective source of energy. The story for natural gas is actually a very interesting story to think about in 2-degree worlds, some of which are represented by some of the lines on the right-hand side of the chart. I won't go into a lot of detail on how natural gas fares in 2-degree worlds because there's so many different outcomes. It really depends on what type of policy or technology path that the world goes down during the next few decades that then governs what is the outcome for natural gas consumption. So to kind of wrap things up here, this is very nuts and bolts on this slide. So I've mentioned that at Conoco we create these scenarios, we create a variety of scenarios, but we don't just keep those within the corporate planning group and spend all of our days and weeks on our hallway crunching numbers. We actually make this more of a company-wide kind of activity. So what we've done over the years is actually develop a system that we call scenario monitoring. And we have roughly 50 people from across the company, that's different geographies, different business units, different functions, that each of them is essentially tapped or asked to look out for a certain category of events. And it's obviously a category that's going to align with what they do in their geography or their function. And what, as they see things occur, maybe it's a news article, maybe it's a discovery by another company, maybe it's a technology breakthrough by another company, we ask them to simply log that event. And that lets us literally track how are things trending over time. We then sit down with each other a few times a year with that group. We have a big conference call. And we provide feedback. My team reports back to the group, hey, this is what you all recorded, this is how things appear to be trending. And we talk through it, and then we provide our management with a summary report on what direction things are going. So again, this is a very nuts and bolts kind of practical thing that we do, but we do find it useful in our company to effectively track and monitor what direction energy trends are taking. So I thank you for your attention, and I will turn this over to the next speaker.
Okay, see if I can find mine. There I am. I can do mine too. Oh, I can do yours too. Okay. Again, thanks for choosing this session, all of you. All, 15 maybe? Just kidding. 10 maybe. So what I'm going to do is a little different. I'm from the Corporate Strategic Planning group at Chevron, and what I'm showing you is actually snippets of what our VP talked about at SAM, the Security Analyst Meeting, and it's a product that we supported. So he talked about it, and what goes on behind the scenes is we did a lot of the analysis and put it together for him. So this is the kind of stuff that we do at Chevron in corporate strategic planning. We do price forecasting, we do a bunch of support on this kind of stuff. We monitor all kinds of energy markets, and we're in touch with a bunch of different SMEs throughout our organization. So this is what our VP talked about. When we do forecasting at Chevron, we try to take a very fundamental, I would say positive approach, meaning we're not talking about the way it should be, but what is the way it is today? So we got to get a handle on what's actually going on. So the first step can be going a little bit beyond the headlines, because headlines are often they're meant to get a response out of you. They're meant to think, oh my gosh, the world is ending. What happens? All the gasoline no more gasoline demand. What are you going to do? So this is a good example of this. We've had a lot of ICE bans, and everybody's saying, okay, EVs are going to take over the world tomorrow. Well, let's take a step back and look at the drivers behind that. Because if we just looked at the headlines, look at this. This is like 1920. There's a headline in there about how EVs are going to take over the world. So you have to take a step back and think about the market conditions and the drivers that you're looking at now. And it's kind of our job to ground everybody in the fundamentals and the assumptions and the drivers behind these things. That's kind of our view of what our job is. We don't make the way the world should be statements. We make the way the world is right now, and we don't know the way the world is gonna be, but we use scenarios as well to try to understand what might be the outcomes in the future. Okay, so when you take a step back, okay, you see the headlines. Well, let's look at the data. What we're seeing is that there's a lot of consumer preferences out there that are kind of counter to those headlines. So consumers really seem at this point to prefer larger vehicles at the world scale. So EVs sold 2 million vehicles last year. That was the year-on-year change upward in SUV sales. So we have to take a step back and think, okay, that's what consumers are preferring right now. If we want to change our path to a different trajectory, what policies are going to have to happen? What's going to happen to energy price, that kind of thing. So we want to take a step back and think about it. One other thing that this is an audience that's very knowledgeable in this space. We often have to communicate how truly large the energy system is and how much capital is required to make changes. And when you put an investment in place today, often it lasts for a minimum of 10 years, often 70 years in some industrial equipment processes. So these things are important. It's really difficult to change things overnight. We've seen some of it happen. I think of the best example recently are shale gas and shale oil. Those things, coal production basically dropped by 1/3 between 2008 and today. That's a big deal. And that was economically and policy driven. But on the global scale, there's a huge challenge in front of us from a capital perspective. The other thing we have to remember is that energy is growing across all consuming sectors. And I mean every single sector. So power and industrial and transportations and buildings and other. There are 3 billion people on the globe right now who are in energy poverty, meaning they don't have access to electricity. So that's an issue. And these people, as they economically develop, are going to be wanting modern sources of energy. And so that's what here is driving energy demand growth in all these sectors. The other thing that we often point out is if you look at the TPE, total primary energy demand on the left, oil and liquids and natural gas are growing, not at the rate that they used to be. So almost every single energy forecast out there in the third-party world has energy, their base case has some degree of growth for oil and natural gas at about half of the rate of history. So there has been a change, but it's not going away on its face right now. And what we also conveyed to the analysts is that we're in a depletable resource industry. So what you see is if you don't invest any capital in the oil that's on production now, you have a lot of decline. So there's a ton of investment that's required just to backfill that and keep that flat. And what we're seeing in the energy space now is, when I say energy space, I'm talking oil and gas traditionally, is a huge amount of competition. There's a huge amount of low-cost supply, oil and gas supply in the world. So the most efficient producers are the ones who are going to be winners. And so there's an imperative to be efficient. And as economists, we all like efficiency. So this is also what we talk about a lot is it's the paradigm change that we've seen just since 2011, when tight oil started to come on the scene. So when tight oil first showed up, everybody thought, oh, it's going to be a flash in the pan, it'll go away. Well, it didn't go away. It broke the back of what we see on top there as a high-cost supply curve. So what happened was it was bigger and cheaper than we thought, so it made everybody else in the world compete. So now, if you want to be an effective and profitable producer, you need to lower your costs, you need to be more efficient, and you need to be as far away from that margin as you can. So our imperative at Chevron and pretty much every oil producer is to be efficient and low cost in any environment. And so what we do is we test our strategy, which is be a low cost efficient provider, against multiple scenarios to see different outcomes. And it's price and volume that we test against. Okay. And then the other one is LNG. LNG's gotten a lot of attention recently as well. There have been huge changes in the LNG market. LNG is set to grow. The demand is set to grow rapidly, but we've seen a huge amount of competition emerge there, as well as the consumers in Asian nations in particular have exerted some more, let's call it, price power. Like they can negotiate with you better because there's more competitive sources of supply to meet their demand. So all in all, what we're looking at as an industry is growing oil and gas demand, slow but growing, and also we're looking at a highly competitive landscape, which wasn't the case in 2011 when everybody thought there was no more cheap oil in the world. And so what we do in corp planning is we put this stuff together. We analyze all the places that we could be wrong, and we try to poke holes in how we could have, what could we do better? Are we not thinking of something? That kind of stuff. And this is some of the output that we produce. So I will hand it over to my next person.
So I'm Catherine Miller. I am president and co-founder of B2 Analytics. Oh, there we go. Unlike my two accomplished colleagues here who are also speaking on subjects related to energy forecasting, we are producing forecasts and marketing and selling those forecasts to external clients. And our real bread and butter has been in forecasting U.S. shale. And so, we've got some big picture concepts that I think our first two presenters have touched on. Now we're about to get into the nitty-gritty of why and how shale is different than maybe some of the energy resources that we focused on in the past. And I want to start off by saying I'm already 45 minutes into my 10-minute deep dive in shale, and we're not going to make it that far because I could speak for 10 hours on this topic. But one of the central pieces of explaining shale to observers who maybe come from either existing or conventional energy markets or other potential industries is that shale has historically not been economic and has not really obeyed the laws of economics. In fact, production and price forecasting throughout the shale revolution has had a lot more to do with watching and monitoring infrastructure, watching the influence of outside capital and its availability, as well as looking at the structures and the incentives for management to grow and potentially sell their assets. So I sort of laugh because I'll read out in the general press about maybe a journalist or someone who's trying to put together a forecast for U.S. shale, and they make general remarks about the rig count and prices and how things should behave. Well, I'd just like to point out for a moment, if you look at Appalachian production, now this is the real powerhouse of U.S. gas in the U.S., the Marcellus and Utica shales in Pennsylvania, West Virginia, and Ohio. That light line there is the dry gas production from Appalachia through time, and you can see it actually grows at a relatively constant pace. Now that is despite prices being below the marginal cost to produce, and also with a rig count, now of course the rigs drill the wells that the production should come from, that's actually kind of fallen and had these fits and starts of volatility through time. So it's not necessarily, when you're forecasting shale, there is some mechanics to it, to understanding how many horizontal feet of pay we're producing from, and understanding what's happening with productivity trends on those developed feet and what the capital costs are there. But so much of it is understanding the bigger picture under which shale has operated and why that system has been changing through time. So another piece, I mentioned that infrastructure has been extremely important to the ability to properly forecast shale fundamentals. And when we look at shale and when we think about forecasting U.S. shale, our sweet spot is really forecasting between 3 months and 5 years out. And this is really the area where we have line of sight into the operational momentum that we've created in history. So you drill a shale well, generally that shale well doesn't come online for another 6 to 12 months, depending on which play it's produced in. And if we've got an area where there's been a lot of investment and growth, it's likely that shale resource will come on even later due to lack of infrastructure. This is what we've witnessed in Appalachia as well as what we've witnessed in the Permian Basin today. However, just when you think you've got your bearings in how to forecast U.S. shale, the system completely changes. So what we've witnessed over the past 2 years is capital availability has changed completely. It used to be that oil and gas companies outspent the cash flow from operations that they brought in. In 2018 was one of the first years that we really got close to the industry being able to self-fund. And that was not through any sort of random coincidence. The capital markets actually closed their doors in many ways to the oil and gas industry, particularly the independents who are responsible for U.S. shale growth. And the reason that they shut their doors is because returns have been very, very poor on the whole. We looked at data from 2017, and in 2017 we estimated that 30 to 40% of shale wells that were drilled were unprofitable even at the wellhead. So that was before you even factored in things like corporate overhead that have to be covered as well. So like I was saying, when you figure that you've got a model that works to forecast shale, then things start to change. So we've had to incorporate and think about how U.S. shale growth works going forward, and a lot of that has to do with following the capital that's available to U.S. shale. And if companies have to self-fund, then we have to think about where that capital is going to come from. So this is where cash flow modeling makes a lot of sense for us to understand the trajectory of shale from here. However, there are still some major risks that are out there that impact kind of the view of not only U.S. shale, but the relative value of assets and basins within U.S. shale. And one of the big risk factors that we highlight, we're kind of specialists at the intersection between upstream and midstream. One of the major risk factors that we highlight is that there are a lot of opponents to infrastructure development for oil and gas in this day and age. And those opponents have really figured out how to target the infrastructure approval process, both regulatory and legal